There is something happening right now inside the Federal Reserve that most people will never read about in a newspaper, will never hear explained on television, and will almost certainly never understand until it has already happened to them. It is not a rumor. It is not a theory. It is a set of policy decisions being made in real time by serious, intelligent people who understand the arithmetic of America's debt problem and who have quietly concluded that the traditional tools, raising taxes, cutting spending, growing the economy fast enough, are no longer sufficient to solve it. What I want to do today is tell you exactly what those decisions are, why they are being made, what they will do to the purchasing power of your savings, and what the people who understand this are doing with their money right now. I have spent more than 50 years studying debt cycles. I have watched governments around the world face this exact moment, the moment when the debt becomes too large to service honestly, and I have watched them make the same set of choices every single time. America is at that moment right now, and the Fed's plan to deal with it is already in motion, whether the people running it are willing to say so publicly or not. Let me start with a number that should stop you cold. The United States government currently owes approximately $36 trillion. That number is so large that it has lost its meaning for most people, so let me translate it into something real. The interest payment alone on that debt, just the interest, not a single dollar going to pay down the principal, crossed $1 trillion in the past fiscal year. $1 trillion in interest payments. That is more than the United States spends on its entire military. It is more than the entire Medicare budget. It is more than the combined budgets of every federal agency except Social Security. And here is the part that should genuinely disturb you. That number is going up every single year, regardless of who is in the White House, regardless of which party controls Congress, because the debt itself is growing at roughly $7 billion per day, every day. $7 billion added to the pile while most Americans are sleeping. Now I want you to sit with that for a moment, because the natural question is, what does the government do about a debt that is structurally too large to pay off through normal means? And the answer, the honest, historically documented answer, is that there are only 4 options. You can grow your way out of it, which requires the economy to expand faster than the debt is accumulating, and at $7 billion per day, that is an extraordinarily difficult bar to clear. You can cut spending dramatically enough to close the gap, which means touching Social Security, Medicare, and defense, the 3 programs that make up the vast majority of the federal budget, and the political system has shown us repeatedly over decades that this is effectively impossible. You can raise taxes aggressively enough to generate the revenue needed, and every serious economist who has modeled this scenario will tell you that the tax increases required would be so large that they would trigger the kind of economic contraction that makes the debt problem worse. Or you can do the 4th thing, the quiet thing, the thing that does not require a single congressional vote, the thing that works slowly and invisibly over years, redistributing wealth on an enormous scale, without most of the people being affected ever understanding what is happening to them. That 4th option is what the Fed is now being pushed toward, and I want to explain it to you with the precision it deserves. The mechanism is called financial repression, and I want you to understand it exactly because the name is deliberately boring and the reality is anything but. Financial repression happens when a government, working in coordination with its central bank, keeps the interest rate it pays on its debt artificially below the rate of inflation. Think about what that actually means. If the government is paying 3% on its bonds and inflation is running at 5%, the real interest rate, the rate after you subtract inflation, is negative 2% every single year. The real value of that debt is shrinking by 2%, not because anyone paid it off, not because anyone defaulted, but because the purchasing power of the dollars used to repay it is being quietly eroded. The debt does not disappear. It becomes worth less. And the people who bear the cost of that process are the people who hold the debt, which is to say savers, retirees, pension funds, anyone whose wealth is stored in paper claims on fixed future cash flows. This is not a theory. It is not a metaphor. It is an accounting identity that has played out in country after country across the last 2 centuries of modern finance. And it played out here in the United States in the most successful example of financial repression in recorded history between 1946 and approximately 1974. I want to walk you through what actually happened in that period because it is the blueprint for what is being contemplated today, and the differences between then and now are the most important thing I can explain to you. In 1945, as World War II ended, the United States had a national debt to GDP ratio of approximately 106%. To put that in context, the same ratio today is around 122% and rising. The government faced exactly the same arithmetic problem that exists today. The debt was too large to pay off through conventional means. Taxes were already high from the wartime mobilization. Cutting spending enough to matter would have meant dismantling the social programs that the public expected to keep. Growing the economy fast enough seemed possible, but not fast enough to close the gap on its own. So the Federal Reserve and the Treasury entered into an explicit, formal agreement. It is in the historical record. You can read the meeting minutes to keep interest rates suppressed below the rate of inflation. The Fed pegged short-term rates at 0.775% and longer, term rates at approximately 2.5%, while inflation in the post-war period ran persistently higher. What happened over the next 28 years is remarkable. The debt-to-GDP ratio fell from 106% all the way down to 23% without a single default, without dramatic austerity, without the kind of economic collapse that standard models would have predicted. The savers who held Treasury bonds during that period received negative real returns for nearly 3 decades. The wealth transfer was enormous, silent, and almost entirely invisible to the people who experienced it. That is the historical precedent the Fed has available to it today. Now, here is where I need to be very precise with you, because the historical comparison is real, but the environment has changed in ways that make the same strategy significantly more complicated and potentially more dangerous in its second iteration. In 1946, the United States was the world's dominant creditor nation. We had emerged from the war as the only major industrial economy whose productive capacity was intact. Europe was rubble. Japan was rubble. The rest of the world needed dollars to rebuild, and they needed U.S. Treasury securities as the safe, stable reserve asset that the entire global financial system would be anchored to. When the Fed suppressed interest rates below inflation in 1946, foreign central banks and foreign investors continued to buy Treasury debt anyway, because the alternative, holding the devastated currencies of bombed out European economies, was far worse. The United States had what I would call structural pricing power over its own debt. The world had no real option but to absorb the financial repression because the alternative was worse. That structural advantage is gone. It did not disappear overnight, but it has been eroding steadily, and that erosion has accelerated meaningfully in the last 5 years. The dollar's share of global currency reserves has fallen from 71% in 2001 to under 58% today, and the direction of that trend has not reversed. Foreign central banks, the institutions that for 3 generations were the most reliable buyers of U.S. Treasury securities, are doing something that should be getting far more attention than it is. They are selling treasuries and buying gold at a rate not seen since the 1960s. The People's Bank of China has added to its official gold reserves for more than 18 consecutive months. The central banks of Poland, India, Turkey, Hungary, and more than 20 other nations have made significant gold purchases, each citing reserve diversification, which is the diplomatic language for reducing dollar exposure. These are not emotional purchases. Central banks do not make emotional purchases. These institutions move with extraordinary deliberation, and they are making a very specific statement about their long-term confidence in the purchasing power of dollar-denominated assets. When the institutions that manage the world's reserve assets are systematically reducing their exposure to Treasuries, the Fed's ability to suppress yields below inflation runs directly into a supply-demand problem that did not exist in 1946. If the world will no longer absorb U.S. Treasury debt at artificially low yields, then either yields must rise to attract buyers, which makes the debt problem worse by increasing the interest cost, or the Federal Reserve itself must become the buyer of last resort, which is a path that has its own very serious consequences for the dollar's long-term value. I want to be precise about what is actually happening inside the Federal Reserve right now, because the public discussion has produced a significant amount of noise that is obscuring the actual signal. The debate about the Fed's next chair, the discussions in policy circles about what some are calling a monetary regime change, and the broader conversation about the relationship between the Federal Reserve and the Treasury are all pointing at the same underlying tension. That tension is this: the Fed has two possible paths forward, and they lead in fundamentally different directions. On one path, the Fed maintains genuine institutional independence, refuses to subordinate its inflation mandate to the Treasury's financing needs, keeps real interest rates positive, and allows the debt burden to resolve itself slowly through a combination of moderate inflation and whatever economic growth the economy can generate. This is the slow, uncomfortable, grinding scenario. Interest rates stay elevated longer than markets want. The economy grows below its potential for years. The debt burden resolves over a very long time horizon, and the pain is distributed across the entire economy broadly, slowly. On the other path, the Fed gradually, and the word gradually is important here, allows itself to be subordinated to the fiscal needs of the Treasury. It keeps nominal rates below the rate of inflation, whether through explicit policy or through the more subtle mechanism of allowing inflation to run above its stated targets without responding aggressively. This is the financial repression path. It resolves the debt faster in real terms. It is less obviously painful in the short term, and it transfers an enormous amount of wealth, quietly and systematically, from savers and bondholders to the government and to borrowers. I do not know which path the Fed will ultimately take. I want to be honest with you about that uncertainty. What I do know, with a high degree of confidence based on 50 years of watching these cycles, is that the institutional pressure on the Fed to take the second path is greater right now than at any point since the 1940s, and the composition of who is having those conversations inside the Treasury, inside the White House, inside the Fed itself, reflects that pressure in ways that are visible if you know what you are looking at. Let me translate all of this into something concrete for you, because the whole point of understanding the macro framework is to understand what it means for your actual financial life. The people who are damaged most severely by financial repression are those whose wealth is stored primarily in assets with fixed nominal returns. If your savings are sitting in cash accounts earning 4% while inflation runs persistently at 5% or 6%, you are losing purchasing power every single year in real terms, even though the nominal number in your bank account is going up. That is the illusion of financial repression. The numbers look fine. The reality is a slow, steady confiscation. Long-duration bonds are in a specific and severe category of risk. A 20-year Treasury bond, a bond ETF with an average duration above 8 years, any fixed income instrument that locks in a nominal yield for a long period of time is structurally exposed to the financial repression scenario in a way that is difficult to overstate. If the government is attempting to hold nominal yields below the rate of inflation for an extended period, there will be episodes, and the history of the 1970s is full of them, where the bond market resists that suppression. Sellers overwhelm buyers. Yields spike violently. Long-duration bond prices collapse. The 2022 U.S. bond market, which was the worst year for Treasury bonds since the Civil War era, was not an anomaly. It was a preview of the dynamic that plays out when financial repression runs up against a bond market that does not want to be repressed. Most American retirement portfolios are heavily weighted toward exactly these assets: long duration bonds, cash, fixed income. The positioning that suffers most in both the mild version of this scenario and the severe version, that asymmetry, the fact that the positioning that feels safest is the positioning most exposed to the specific risks that the current environment presents, is what I think most investors are genuinely failing to see. Now let me tell you what the people who understand this cycle historically have done with their capital, because this is not speculation. It is pattern recognition across documented historical episodes. The people who preserved and in many cases grew their purchasing power during the post-World War II financial repression era were, without exception, holders of real assets, not paper claims on future cash flows, real physical, productive assets whose value is anchored to something tangible, equities in companies with genuine pricing power, the ability to raise prices as their input costs rise, performed well because their nominal earnings rose with inflation, even as the real economy was being gradually repressed. Companies that owned physical productive assets, manufacturing capacity, farmland, resource deposits, infrastructure, retained real value in a way that paper claims on fixed cash flows simply could not. Real estate financed with fixed rate mortgages was perhaps the single most powerful beneficiary of that era. Think about the mechanics. You borrow $100,000 at a fixed interest rate. Inflation runs at 4% or 5% for 25 years. The nominal value of your property rises with inflation, but the real burden of your debt erodes every single year. By the end of that period, you have transferred an enormous amount of real wealth from the lender to yourself, simply by holding a real asset with fixed rate debt financing. That mechanic is available today in the same form it was in 1946. The gold market was officially suppressed in price during the Bretton Woods era, but since the closing of the gold window in 1971, gold has functioned as the asset of last resort for investors who need to preserve purchasing power outside of the paper financial system. And the signal coming from central bank gold buying right now is one of the clearest and most consistent macro signals available to anyone paying attention. I want to address one thing that comes up consistently when I have these conversations, because it leads people to a conclusion that I think is partially right but dangerously incomplete. The argument is, if the US dollar is being debased, just diversify internationally. Buy foreign stocks, buy foreign currencies, buy foreign bonds. And while I understand the intuition, the mechanical application of it misses something critical. Every major developed economy, Japan, the United Kingdom, the Eurozone, is dealing with versions of the same debt trajectory that the United States is dealing with. Japan has been running explicit yield curve control, the textbook definition of financial repression, for nearly a decade. European government debt to GDP ratios are at or near historic highs across almost every major economy. The British pension crisis of 2022, where the entire UK pension system came within hours of a catastrophic collapse, was caused by exactly the same dynamic: long-duration bonds, financial repression, and a sudden violent repricing. International diversification distributes the risk differently. It does not eliminate the underlying exposure, because the underlying exposure is not American. It is structural to modern sovereign debt across the developed world. The assets that genuinely preserve purchasing power across financial repression episodes are real assets with intrinsic scarcity, and that category transcends national borders and does not depend on any single government's decision about its monetary policy. Here is the thing I want you to understand about the moment we are in. The Fed's plan to deal with America's debt is not a conspiracy. It is not a secret. It is the logical, inevitable response to an arithmetic problem that has no clean solution. The people inside the Fed, inside the Treasury, inside the major financial institutions that advise both understand the dynamics I have described today. They understand them better than I do in certain respects because they have access to data and analysis that I do not. What they cannot do, what no government official can do in a democratic system, is explain these dynamics honestly to the public. Because the honest explanation is that the plan involves a multi-decade, slow motion transfer of purchasing power from savers and bondholders to the government and to borrowers, conducted through the mechanism of keeping real interest rates negative for an extended period. No politician can say that out loud. No Fed chair can say that out loud, but the policy can be implemented anyway, quietly, meeting by meeting, year by year, while the public focuses on the headline inflation numbers, the monthly jobs reports, and the political theater of budget negotiations that never produce the structural changes needed to solve the underlying problem. The central banks buying gold are telling you what they think about the long-term value of paper claims on government promises. The bond market volatility of the last 3 years is telling you that the repricing process has already begun. The question is not whether this is happening. The question is whether you are paying attention to the right signals and whether your financial positioning reflects the environment that is actually developing rather than the environment that used to exist. I have been through multiple complete debt cycles in my career. I watched the inflation of the 1970s build slowly and then overwhelm the system until Volcker had to break it with 20% interest rates. I watched Japan enter its debt trap in the 1990s and spend 3 decades trying to escape it. I watched 2008 reveal how much leverage had been hidden in the global financial system and how quickly confidence can collapse when that leverage unwinds. Each of those episodes looked manageable until it did not. Each of them had clear warning signs that were visible in advance to people who were looking at the right data. The warning signs in the current environment are not subtle. A debt that is growing faster than the economy can service it. A bond market that required the Fed to intervene directly in 2020 to prevent a liquidity crisis. Foreign central banks systematically reducing their Treasury holdings. Gold at all-time highs, not driven by retail speculation, but by the deliberate reserve management decisions of sovereign institutions. The spread between short-term nominal rates and actual experienced inflation persistently narrowing. These are not random events. They are the early stage manifestations of the dynamic I have described today, and they are telling a coherent story to anyone who is looking at them together rather than in isolation. The final thing I want to say is about what this moment requires of you personally, not as an abstract exercise in macro analysis, but as someone who has savings, who has a retirement to fund, who has built financial security over years of work, and is now watching the rules of the game change in ways that are not being explained to you honestly. What this moment requires is not panic. Panic is never a useful response to a macro environment, because panic produces decisions based on the immediate emotional response to risk rather than the careful analytical response to it. What this moment requires is clarity. Clarity about what the actual risks are. Clarity about what the historical precedents tell us about how those risks manifest over time. And clarity about whether your current financial positioning was designed for the world that existed for the past 40 years or for the world that is developing right now. The world of the past 40 years was a world of falling interest rates, rising bond prices, and an expanding dollar-denominated financial system that rewarded passive holders of financial assets. That world was built on a specific set of conditions: low debt relative to GDP, credible Fed independence, strong foreign demand for dollar assets, and the unique position of the dollar as the unquestioned anchor of the global reserve system. Those conditions are changing. They are not gone, but they are changing, and the direction of change is clearly visible to anyone who is looking at the capital flow data. The central bank reserve management decisions and the long-term trajectory of the debt. The question I am asking you to sit with is not what is the Fed going to do next quarter. That question is too narrow for the environment we are in. The question is whether your financial life is structured to navigate a decade or more of financial repression, of negative real interest rates, of slowly eroding purchasing power and paper assets, the same way the generation that came before us had to navigate the same thing between 1946 and 1974. Because that generation learned something that the generation that came after them forgot. Paper promises from governments have a long history of being worth less than they appear to be at the moment you receive them. Real things, productive assets, physical goods, businesses that make things the world needs, land, gold, the assets whose value is anchored to reality rather than to a promise, have a long history of surviving the cycles that destroy paper wealth. The market is pricing something right now. The central banks are telling you something right now. The only question is whether you are listening.